Market View presentation. I'm Josh.
I'm Anthony.
And I'm Randy.
And today we're going to be taking an in-depth look at the Australian dollar and US dollar exchange rates, as well as the Australian dollar and Great British Pound exchange rates. First of all, we're going to be looking at the Australian dollar and US dollar. So in summary, following the global financial crisis of 2008, the only thing consistent about the exchange rate between the US and Australian dollars was the amount of fluctuations experienced. In the past 12 months alone, the dollar has been oscillating between a low of 68 cents and a high of 78 cents. However, uncharacteristically, over the last 3 months, the dollar has remained somewhat stable at 75 cents, as you can tell from this graph from stockchart.com.
Interest rates. The objective of the RBA in regards to monetary policies is to maintain the stability, prosperity and welfare of the people and currency in Australia, as well as full employment of the entire population. The way the RBA influences these things is through adjustments of interest rates. In the United States, the central bank operates in a similar fashion. The current record low rate of 1.5% in Australia is good news for people who are trying to borrow from banks. However, it's bad news for the exchange rates for Australian and US dollar. Interest rates have a linear relationship with exchange rates, hence the low interest rates in Australia has led to the weakening of the currency. In stark contrast, the US has experienced a growth in interest rates of 0.5% over the past year, leading to an increase in demand for bank loans. Reuters said in June this year that a rise is just the beginning, with 2 further hikes in interest rates expected before the end of the year. This has led to an appreciation of the US dollar against the Australian dollar, with Reuters saying this is an attraction of foreign investors. As you can see by the RBA, it shows the cash rate of the Australia and United States.
Inflation rates. Why interest rates and exchange rates share a linear relationship? The link between the inflation rate and exchange rate is the opposite, sharing a largely inverse relationship when the inflation rate is up. The exchange rate of the currency depreciates as a result. According to Investopedia, a very low rate of inflation does not guarantee a favourable exchange rate for a country, and an extremely high inflation rate most likely to impact the exchange rate negatively. This was the most evident during the global financial crisis of 2008, when the inflation rate in Australia peaked at 5% and the exchange rate of the US dollar dropped to uncharacteristically low 60 cents. The current low inflation rate is unusually matched by the low exchange rate, an event which is seemingly unprecedented within the financial markets, with the RBA saying that normally operate in the opposite direction. In the United States, the inflation rate is currently at 1.1%, giving the impression that the economy is in a relative stable position. This idea is further enhanced by the negative inflation rate experienced in the US in 2015, a time where the exchange rate was appreciating against the Australian dollar following the global financial crisis. The idea of this low inflation is that it helps the economy recover from the recession, hence the news. As you can see from the diagram here.
Now the relative growth rate. The exportation of goods and services to Asian countries, and China in particular, is a crucial part of the Australian economy. According to the Commonwealth Bank of Australia, more than 75% of Australia's exports go to this part of the world. While the economy of China was booming, Australian exchange rates were on the improve. However, over the last few years, the Chinese economy has been slowing, leading to a depreciating demand for Australian products. An example of this would be the recent coal and iron ore price decrease. These are the two of the most critical products for exportation in Australia, with these low demands triggering a decline in economic growth. These prices have in fact stabilised this year, even experiencing a slight increase, which is a positive sign for the Australian economy. However, according to the Commonwealth Bank of Australia, the decrease in commodity prices means our trade terms are weakening. With these weakening trade terms, the exchange rate will diminish. As you can see, prices have been decreasing.
Future predictions. Despite the US Federal already saying that they are reluctant to increase interest rates beyond the end of the calendar year, the rising of interest rates expected in the US economy throughout the remainder of 2016 has set a key base for the economy. The successful budgeting strategies employed over the last year in conjunction with the low inflation rates makes it clear over the next 3 to 6 months the economy will continue to strengthen, resulting positively in the international exchange rate. In contrary with the Australian dollar, the low inflation rate doesn't seem to affect it. However, the struggling Chinese economy has led to a sizable reduction in Australian exportations, which we believe will lead to a further decrease in Australian exchange rates in the US.
Now we're discussing Australian dollar to Great British Pound. Following the vote to leave the European Union on the 23rd of June 2016, the most immediate effects were seen in the financial market. Most obviously, there was a sharp fall in sterling, particularly against the Australian dollar.
And the interest rates, as mentioned previously, the interest rate in Australia is currently 1.5%. Recently, the Governor of the Reserve Bank of Australia, Glenn Stevens, announced this interest rate of 1.5%, depreciating from 1.75% in August 2016, is an effort to support the domestic exporters and trading sector. The RBA's latest interest rate cut was a response to the growing concern of low business investment levels into the non-mining industries in the economy. The attractive record low interest rate is expected to encourage capital inflow through luring foreign investors to invest funds into the non-mining industry and the economy. Evidently, this effect would stimulate strong demand for Australian currency from foreigners, most likely appreciating the Australian dollar against the Great British Pound. Inversely, as a response to poor economic growth and growing concern over the increase of the inflation rate, the Bank of England's Monetary Policy Committee has decided to cut the interest rate from 0.5% to 0.25%. The most immediate effects following the vote to leave the European Union in June was the sharp fall in sterling, which against the Australian dollar was a staggering depreciation of 11%. Due to the economic and political uncertainty, not to mention the turmoil of consumer confidence in the United Kingdom, and also the minimal prospects of growth, the British pound is expected to depreciate against the Australian dollar even further due to growing export demands and an increase of commodity prices. As you can see, interest rates have been dropping.
Inflation. Currently, Australia is experiencing a drastic plummet in inflation rates to a 17-year low of 1% from the previous 1.5%. This means the overall level of prices is decreasing, likely stimulating strong demand for domestic goods and services. This could potentially lead to the Australian market into an expansionary position to continue to grow, as the exporting industry is demonstrating signs of growth, showing a likelihood to improve from its current weak position. The RBA quoted that the underlying inflation is expected to remain around current rates at the near terms, before picking up to gradually around 2% by the end of forecasting period. If the UK experiences higher levels than Australian partners, it will expect less demands for exports due to political and economic uncertainty of European consumers, therefore creating low demands for the British pound, further depreciating the value of the currency. As a result of these factors, the value of the Australian dollar is expected to continue to soar against the depreciated value of the British pound.
Relative growth. Strong forecast by the RBA has indicated that the Australian economy is growing at an above trend pace over the 2016 period. GDP growth is expected to be around 2.5 to 3.5% over 2016, before increasing to 3 to 4% by 2018. This is due to the fact that the unemployment rate has remained and declined moderately at 5.5% over 2016. Commodity prices are above recent lows prior to 2016, following the substantial decline from the previous 5 years, partly because of the reduction in the supply of some high-cost producers of commodities, including iron ore, coal, and introduction of natural gas to the market. Furthermore, domestic exporters are taking advantage of the low exchange rate to export high volumes of resources, minerals, services to other nations, allowing the Australian economy to sustain and improve growth. Whereas the UK vote to leave the EU jeopardised the future trading relationships with the EU in the longer term. The rate of the consumer price inflation has remained low at 0.3%, as commodity prices have generally remained relatively weak, partly due to relatively subdued global demand growth. As to a fall from a 12-month low, the effect of the recent fall pound. According to PwC, UK exports equate to 27% of the GDP, nearly half of which the rest of the European Union. As you can see from the graphs, export volumes and commodity prices.
So what's expected in the future? Following the leave Following the vote to leave the EU on the 23rd of June, the most immediate effect was seen in the financial markets. Most obviously, there was a sharp fall in sterling, particularly against the Australian dollar by 11%. Following from the uncertain political and economic situation over UK, the Bank of England Monetary Policy Committee voted to cut the interest rate to a record low of 0.25%, which is indicated to improve the UK net exports industry into a favourable direction, making a positive contribution to GDP growth in 2017, which contributes to 27% of the UK GDP. Compared to the Australian economy, currently experiencing positive growth and low interest rates of 1.5%, the economy is projected to improve as the attractive rate encourages capital inflow from foreign investors into the economy. With the struggling British economy, the political turmoil and future rate of low demand for British exports relative to Australia's stable growing economy, we believe that the Australian currency will appreciate against the depreciating British pound. And it goes to show right now that the Australian currency is depreciating against the British pound.
The Australian currency is appreciating against the Great British Pound, yeah. Thank you for listening to our presentation.